My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to demonstrate how to measure, recognize, and disclose bonds payable when they are issued at a discount. And so what we are going to do here is use an example, actually one of the exercises from the Spiceland textbook. This is exercise 14.3, Bradford Company. And I have copied the information from the textbook here. So on January 1st, 2013, Bradford Company is going to issue some bonds. And they are issuing bonds with a stated rate of interest of 10%. The bonds are dated January 1st. In other words, they're not issuing them between interest payment dates. So that will simplify things a little bit. And the face amount of the bonds is $80 million. So this is a fairly substantial bond issue. And the bonds will mature in 10 years on December 31st, 2022. So they'll be issued January 1st, 2013. And they'll be outstanding for all of 2013, 14, and so on until the end of 2022. We are told also that bonds of similar risk and maturity would have a market yield of 12%. Interest is paid semi-annually on June 30th and December 31st. So this is a very standard bond issue, 10 years outstanding or 10-year maturity. The bonds are going to be issued so that the yield for investors is 12%, even though the company is only paying 10%. Right, so there are two things that we need to make sure that we get cleared up first as it relates to the measurement issue. The first thing is we want to know whether the bonds, or understand whether the bonds are going to be issued at face value, at a discount, or at a premium. And if you recall from the previous video, the relationship between the stated rate of interest and the market rate of interest is what determines whether the bonds will be issued at face value, a discount, or premium. In this particular case, the stated rate is less than the market rate. Bradford is willing to pay 10% annually, but investors want a 12% rate of return. That means that the bonds will sell at a discount. There's only two ways that bonds can be issued in such a way that both the seller and the investors are satisfied. Remember that the bond certificates have already been printed. This is an $80 million bond issue. The bonds typically are issued in $1,000 certificate denominations. So there's 80,000 certificates already printed, and the company is not going to go back and reprint or change the stated rate of interest from 10% to 12%. So the only other way to get the market investors, the investors happy, is the investors will simply adjust the dollar amount that they're willing to lend initially. So they're going to get paid 10% of $80 million, but they will lend significantly less than $80 million to Bradford Company, such that their yield will actually be 12%. And so all that means is that the bonds are going to sell at a discount. So now we need to deal with the actual measurement. What is the dollar amount that Bradford is going to collect from investors? We know that the amount is going to be something less than $80 million. That's what it means for the bonds to sell at a discount. So we need to collect some information here and sort of organize some information to make it useful for determining the present value of the cash flows. So the first thing is we need to know what our number of payments per year is. Interest is going to be paid semi-annually on June 30th and December 31st. So that means that we are going to be making 2 payments per year. Okay, so payments per year is going to be 2. The bonds are going to be outstanding for 10 years. Since we are making payments twice a year, that means that we have 20 interest payment periods here. 10 years, 2 payments per year, is 20 interest payments altogether. The discount rate, the rate at which we will discount those future cash flows, is the market rate of interest, which in this case is 12%. The only thing that the 10%, the stated rate of interest, is used for is to actually determine the amount of cash that's going to be paid out. But the cash flows themselves are going to be discounted always at the market rate of interest. And so that's what we need to pay attention to here. Okay, so I'm going to bring up my financial calculator here, and let me resize this so to make sure that you can see everything that's going on here. All right, so I have my financial calculator here. This happens to be the Texas Instrument calculator. And I have to do a couple of things to make sure that I get the correct answers here. First thing is this row of buttons right here, N, interest rate per year, present value, payment, and future value or face value. That's the row of buttons that we're interested in using to help us determine the present value of the discounted cash flows. So the very first thing I want to do always, before I start any problem of this nature, is to clear out the time value of money registry. You don't want to accidentally combine data from various problems into a single computation. And so the way I do that is I hit the second key, or the function key here, second, and clear time value of money. That will clear out all the time value of money registries. The other thing I need to do is to make sure that my calculator is set up to handle 2 payments per year. You see, right here is P/Y, that's payments per year. So I hit Shift and hit that key, and notice that my calculator defaults to 2 payments per year. I can change that. For example, if we were making quarterly payments, then I would just hit 4 and enter, and that would tell me that I've got 4 payments per year. I could even change it to 12 payments per year, monthly payments. That might be something that you would be finding useful if you were working with a standard personal mortgage of some sort. In any case, we're working with a bond here, and we are making payments twice a year. So 2, enter, to make sure that my payments per year is equal to 2. And I can hit the clear button a couple of times to clear out of that menu path. All right, so now I'm ready to determine my present value. PMT, payment, is used to refer to equal periodic payments. In this case, that's my interest. So I know that I'm going to borrow $80 million, and the stated rate of interest on this bond issue is 10%. So $80 million times 10% times half of a year, or 6/12. Remember that the 10% is an annual rate of interest, but I'm going to be making interest payments twice a year. The total amount of interest payments for the year is $8 million, but the payments are going to be divided into 2 payments for the year. So 8 million times 0.5 or times 6/12, so however you want to do that, gets me to $4 million in interest payments. So my payments are going to be $4 million every 6 months. Now, since these are payments or cash outflows, I always want to make sure that I get the direction of my cash flows correct. So I'm going to indicate, I'm going to use the plus minus symbol here, and make sure that I've got $4 million as a negative. A negative $4 million is my payment. The other cash outflow that's going to occur is the $80 million of principal amount at the maturity date. In 2022, the company is going to pay $80 million. I'm going to put that in as a negative as well as the face amount. All right, so far what I've done is I've inserted $4 million as my periodic interest payment and $80 million as my face amount that is going to be distributed 10 years from now. The rest of this is then to insert the remaining information that I need. So for example, N, how many interest payment periods do I have? Well, we have 20 interest payment periods. N is equal to 20. We determined that earlier. The discount rate, the rate at which the future cash flows will be discounted, is 12%. And I just insert that as 12. Interest rate per year, I just insert as 12. The calculator does all the decimalization that's necessary. We don't have to worry about the half-year convention and all that sort of stuff. It's just interest rate per year is 12%. So now what I've done is I've told the calculator I've got some number of periods. My interest rate is 12% a year. I know what my payments are, my periodic payments are, and my future value is. What's left is to determine the present value. And so that's just compute present value, and we see that the present value of the bond is $70,824,063. Notice that this does represent a discount. The face value of the bonds is $80 million, and we are going to discount the bonds a little bit because of that difference between the stated rate of interest and the market rate of interest. And so the bonds are going to be issued at a discount. Specifically, Bradford Company will be able to borrow or collect from investors $70,824,063. And so that is the present value of our bond. Okay, so now in part 2 of the video, we will talk about how to recognize and disclose those bonds. The purpose of this video was simply to get to the measurement process itself.